Hello, everyone, and welcome to the latest edition of AML RightSource Voices. Our topic for the day is best practices for managing your high-risk customers. I'm hoping that we will have kind of a fun and entertaining conversation today. If you haven't listened into AML RightSource Voices webinars in the past, we do it in a very conversational manner. If you're looking for a deck to take away at the end of this with all sorts of content, that's not what we do. The good side, though, is that we do record these. So if there's anything that you miss or anything that you want to share with colleagues or friends, it will be recorded and we'll send that out to everybody that signed up. And so I'll jump in to start talking about our panelists for the day. We have a great pair of folks that's going to give you lots of insight and great information. They're both very kind of well-established in the AML community. First up is Nancy Schicker. Nancy's been in the banking and financial services industry since 1994. Since 2006, has focused on improving the detection, prevention, and reporting of financial crimes through various AML officer and financial crimes executive roles at top global banks. She has experience managing large multifunctional departments, including concurrent consultant engagements and regulatory remediation activities. She's led the rebuilding of AML, KYC, and sanctions and anti-bribery and anti-corruption programs, including the development of enterprise AML and sanctions risk frameworks, implementing new client customer risk rating models, KYC guidance, documenting and optimizing transaction monitoring models, and establishing quality assurance financial crimes compliance operating models for ongoing monitoring and testing. She has an MBA in marketing from San Francisco State University, a bachelor's degree from Texas A&M. She's a certified risk compliance manager, a certified anti-money laundering specialist, a certified financial crimes investigator, and a certified privacy professional. She also serves on the Association of Certified Anti-Money Laundering Specialists, Southern California Chapter Board. Welcome, Nancy.
Thank you.
Next up is Hunter Krieger. He's Senior Vice President, Director of Financial Crimes Operations and OFAC Officer for Blue Ridge Bank. He's the former FIU Director and OFAC Officer at Atlantic Union Bank. In his current role, he serves as a subject matter expert and escalation point for all sanctions, OFAC, watchlist-related matters, including 314 information requests, as well as EDD, CDD, and CTR. Hunter has held multiple positions at Deloitte in their Independence and Conflicts Network and serves on the ACAMS Virginia's chapter board. He received his degree from the College of William & Mary Economics and is a certified global sanctions specialist. So I think you can see from those intros that we have some folks with a great pedigree that I think are going to give you lots of information. One thing I'll add, we do have the Q&A set up. So if you would like to ask questions, so I'm guessing you signed up for this to hopefully hear something. If there's something that we're not talking about that you want to hear about, please put it in the Q&A and we'll get to them when we can. I'm going to jump right in. I should probably introduce myself, I guess. My name is Chuck Taylor. I'm head of financial crimes advisory at AML RightSource. I've been doing that for about 6 years. Prior to that, I was a practitioner. I was a BSA officer for about 20. And I've been involved in the industry for quite some time. I have a little bit of subject matter expertise that I'm going to pepper in while we're talking. I can't resist sometimes to weigh in on these topics, even when I'm moderating, but I'll try to limit that. I'm going to jump right in and I'm going to start with you, Hunter, with a very simple question that I think if I asked, 20 BSA officers or BSA professionals, they might give me different answers. So I'm going to ask you to start. What is a high-risk customer?
Sure, yeah. So a high-risk customer we can think of is a customer that one day may pose some danger to your business. So in the BSA AML world, that represents customers that present a higher risk of money laundering, terrorist financing, or other illicit financial crimes. This could either be due to patterns of behavior or inherent risks due to the customer type, such as money services businesses, or other sectors such as locations, such as HITCAs, HIFCAs, or other foreign jurisdictions as defined by the FATF.
Can I ask you a question there that comes up a lot in my practice? Folks ask me about the use of HIFCA and HITA information in rating high-risk customers. And I think there's nuance to it, right? Because depending on the footprint of your financial institution, everybody might be designated that way. And then it doesn't seem like a reasonable factor to use because it's kind of adding extra points to everybody. In other instances, maybe just a part of your footprint is there. So can you fill me in a little bit on kind of how you use that, and is there any nuance to how you use those designations?
I think you make a great point. With HITCAs and HIFCAs, footprint's really important. For financial institutions I've worked with in the past, our footprint is the I-95 corridor. And so you can make risk-based decisions to say that if we were to include HITCA, HIFCA, or if we're depending on your customer risk rating system, you could artificially inflate numbers. It's something that is very nuanced. You want to evaluate it in the terms of where does your bank exist, where does your customers exist, and what type of products are they using as well as that. So I think it's a very nuanced point, just as you noted there, that there's not a one size fits all answer.
I would just add that some regulators are really excited about it and want to make sure that you're using it. Otherwise, are a little more pragmatic and are okay with however you designate it. Nancy, I'll go to you because, like I said, we get different answers when you ask that question. What's a high-risk customer? So I'd love to hear your thoughts.
Absolutely. So, the FFIEC manual, let's just start with that. That's kind of your baseline for what regulators consider clients that may, quote unquote, pose a heightened risk. So I would start with that. However, that's not really your only source when you think about how you define customers. Really focus in on what it means to be high risk to your firm and make sure that gets customized in alignment, as Hunter mentioned, a few of the aspects, but also if you're looking at your firm's products and services that you're offering, the level of complexity, the size of the firm, and all of this is going to comprise what is not only your risk appetite, so that when you have a client that meets or exceeds those risk appetite tolerances, then obviously that is going to be a high risk client and will then require commensurate controls put in place to manage and monitor it. So what is really important, it comes down to, is documenting and defining in your policies and procedures and that process of how you evaluate these factors and understand, and to be able to understand again the nature and purpose of your customer relationship and how these factors can contribute to your firm's risk ratings and pose at higher risk.
And I think, Chuck, one of the really important things that Nancy noted there is that, not all higher risk customer types are created equal. And however you make that risk-based decision, robust documentation is very important, especially with those regulator conversations.
Absolutely. Thank you both. I think you both kind of mentioned an important point in that it's up to your institution what you decide is a high-risk customer, right? Some institutions have very specialized niches that they're doing. Some institutions are banking, say, money services businesses, but they have built up the controls around money services businesses so well. They don't take anybody on that they're not willing to take on because they don't have the right controls. And in the end, some institutions can have what would typically be identified as a high-risk customer kind of in general. They're so good at it, it may not be a high-risk customer for them because they're monitoring it so well. For the team in the back, if you could put up our poll question, we're going to move on to a question again that I think if I ask 100 different BSA officers, I'm going to get 100 different answers. And so the question, I'll read it to you. If you designate a customer as a high-risk customer, are they always a high-risk customer? Option 1 is yes, once a high-risk customer, always a high-risk customer. Option 2, no, risk ratings are fluid and can be changed freely. And then number 3, risk ratings can only be changed on an exception basis with high-level approval. It's probably some other answers, but I think those 3 probably cover what most people do. We'll give it a second to let the answers come in. But Nancy, I'm going to go to you to start with that question. So in your mind, how would you answer this poll question?
I've seen risk ratings are fluid and they should be fluid. And it's not so much the risk rating, but it's the why behind it. Why did it change? What are the factors that go into, first off, foremost, establishing what is a high-risk customer, as we mentioned earlier. And then second, how you monitor for those changes. It's really about those controls that you put in place. So should you, for example, you could downgrade your client, but and I've seen organizations where it will say X number of clients have been downgraded, X number of clients have been upgraded, but there's no particular reason that's listed around what changed. And that's what's more important to me is the what and the why behind that. Because we want to, again, make sure that we have, really based it on observed activity, changes in the client profile. Maybe they've changed their job, and funds are coming in from a different source, suspicious activities or any sort of law enforcement inquiries. You really want to make sure all of that is baked into an understanding the methods and the reasons for those changes. And of course, monitoring. We're going to talk, I think, a lot about internal control monitoring and how you revisit that as we go forward.
Excellent. Thank you. And so the results of the poll are up. It looks like most people agree with you. In the middle there, risk ratings are fluid and can't be changed freely. The next most at 25% is risk ratings can only be changed on an exception basis. And then the smallest amount at only 6%, which is a little surprising based on what I hear from a lot of clients, is that once a high-risk customer, always a high-risk customer. So I guess there's always a little bit of exception. So the last one is probably where a lot of people go. Hunter, I'd love to hear your thoughts.
Yeah,
once a
I think that
customer, always a high-risk customer? Go ahead.
I tend to go with option 2 in a theoretical example, but when I'm thinking about practical purposes, it really comes down to what your institution's profile is. Depending on the size and complexity and staffing you have at your risk rating system, you may be stuck with option number 1 in more of a practical sense. I think that in a perfect world, risk ratings are totally fluid. It can be changed freely. And I think that most people think about that in the opposite way, where maybe they're doing an ad hoc review and they raise someone up to a high-risk client. But definitely, as to your point earlier, not all customer risk ratings are equal, and you may get your hands around a client type sufficiently where you don't feel that they're high risk anymore. But it does generally require some robust documentation, Sarah. So it's fluid, but it depends, and it really comes down to your practical approach.
Fluid, but not too fluid that you're driving.
That's right. That's right.
You crazy with changes every week, right?
100%.
Yeah.
So to me, it's kind of it's very easy to risk rate somebody higher than what they are, right? It's easy to say, okay, this person's medium based on what they're doing. I'm going to rank them higher. This person I've never really identified as high risk, but based on the transaction they're doing or the negative media that I see, I'm going to make them a high risk customer. So easy to go up, but I'll put a pin in what you both said. It's great. And I think the idea of having a fluid customer risk rating process is optimal, but you have to have the infrastructure in place to document it properly. I always lean on, when I was a practitioner, many times I made decision based on what am I willing to defend this to a regulator, right? Am I willing to sit in a room with somebody who, and forgive me, I'm going to say this, is out to get me? They're not always that way. Many of them are great and just trying to be helpful, and that's the idea. But sometimes you come across a regulator that kind of wants to get you on something, and am I willing to defend that in front of them? I kind of always tried to lean towards that way and have a fluid process and defend it as necessary. Sometimes it's easier to leave somebody high risk because you don't want to have that discussion. So it's nuanced and fluid and all those types of things. So thank you both on that. I will throw out a little bit of my own bias in that I think the kind of whole high-risk customer process is a little bit silly. And I can say that because I'm not a practitioner anymore. I don't have a regulator looking over my shoulder. But I think we spend a lot of time identifying, monitoring, risk rating customers that in the end probably aren't really going to be much of a risk to the institution. I think in general, if somebody's really a high-risk customer, you're not going to bank them at all. They're going to be left out at the front door. And I'm guessing both of you have a prohibited list of certain types of customers you're just not going to take on. And then maybe you have higher risk customers that you're going to take on, but do a little more due diligence. So I think in the end, high-risk customers, you identify, you monitor on an ongoing basis in a manual way. You know them really well. I think based on what I've seen in my former life and my current practice, it's more likely you're going to file SR on a non-high-risk customer. And that's just me. I think those come up through transaction monitoring, negative media, all those kind of things. Your high-risk customers you know so well that if something's off, you ask a question and normally they're going to answer it and all those things. But I'll get off my soapbox and go to the next question. So let's see. I'm going to start with you, Hunter, on this. What's the current regulatory environment around high-risk customers? What are you feeling when you go through exams and discussing things with regulators?
Sure. So I think the kind of the hot button issue with high-risk customers is banking as a service. Making sure that, if you read the enforcement actions, it is definitely a narrative and theme that you are responsible for high-risk customers, soup to nuts, full stop, as the sponsor bank. And, at the end of the day, you own the risk. You're the regulated financial institution. And whether you make a risk-based decision to be reliant on a third party, or you are being more of a traditional dictate down sponsor banking relationship, that seems to be a really big point of emphasis across all the different regulators. And I know that my personal opinion would be that it seems to be that the direction that they want is that you should be dictating down, that the bank should, at a minimum, have direct insight and oversight as to how high risk customers are being stopped at the door and evaluated and approved or not. And so I think that banking as a service seems to be at present really the highest focus issue for high risk customers. And the challenge there is that it's a nationwide, generally, customer base in a way that some of the sponsor banks may not be used to. And so I think that feels to maybe be the reason behind it.
Great, thanks. Nancy, how about you? What are you hearing from examiners?
Oh, it's definitely the examination of regulatory scrutiny has ramped up, especially in the last 2 years. 2023 had a 57% increase in enforcement actions over 2022. 2024, we're on the same kind of trajectory where you have 10 enforcement actions just since May, and this is specific to BSA AML. And then 4 of these also include fintech partner banks. So we're really seeing that the regulatory action hone in on those particular risks. And I think it mainly comes down to how can you be proactive? How do you get the support of your board and your senior leadership to focus in on the improvements and controls that are needed? And I think a lot of this does come down to building up internal controls and not looking at financial crimes as a cost center, but as a protection for the bank.
Yeah, I agree. I think, that's a really good point about not doing compliance as a cost center. It's an investment in your future protection. Spend the money up front to avoid the penalties on the back end.
A great analogy that somebody used for me once, and I'm afraid I can't give credit, but they said kind of the BSA AML financial crimes team is like a catcher on a baseball team, right? Nobody really notices how good a job you're doing until you mess up, right? If a ball gets passed or you don't throw somebody out at second base or whatever, somebody notices. But the rest of the time, you're just back there taking care of business, keeping everything going, managing the game. And it's underappreciated. It definitely shouldn't be considered a cost center. It's a place where you're managing expectations and managing regulators and keeping the bank out of trouble. And I'm going to throw a wild card at you, Nancy, to start. We didn't really talk about this, but I know it's something you think about. When consent orders come out from the regulators with different types of things, and maybe specifically talking about high-risk customers, but maybe not. How do you use those when you're reviewing your processes, your risk assessment, all those types of things? What do you do with those?
Absolutely. Every consent order that comes out is analyzed for what went right or what went wrong, mostly what went wrong, and evaluated against your internal program. And this includes creating a risk assessment, in a sense. What do your internal controls look like? Could the same thing happen at your financial institution? And how do you address this going forward? What improvements and processes do you look for? And it does really become a scenario of, I would encourage anyone to take the FFIEC exam manual and look through that. And when you first when you first encounter this situation, whatever it is, new organization, new role, that you do assess it so that you understand where are the risks, and do that in the beginning so that you're really clear when things start to unfold and you have a better understanding of that current state.
Hunter, how about you?
So I use enforcement actions the same way I do OFAC settlement agreements. I use them to kind of forecast out points of emphasis from the regulators to say, what are they looking at? What are they looking for? Where do I need to make sure that, just like Nancy said, do I have processes in place? Are they documented appropriately? If this happened here, how would it go? Make sure that we can identify and work with your controls team. Make sure that you're doing adequate testing to say, plan out if this was to happen at our institution, would it be caught if everything works well? Or do we have something where we need to enhance our processes and procedures for sure?
That is so important, Hunter, especially when you talk about the testing, your testing plans, because you put your testing plans in, a year in advance. Yep. And so there needs to be some sort of flexibility and being able to say, okay, we've started to see this trend. And I think that's also really important with enforcement actions of any kind. Whether it's compliance, whether it's, the alphabet soup of compliance, or whether it's BSA AML sanctions, that you look for those trends and you look at what's important to those regulators. A lot of us have Fed oversight as well, in addition to your maybe your prudential regulator. So understanding what's important to all parties involved, whether that's, and I won't go through the names of all the regulatory agencies, but each one of those may have a different focus. And so you'll want to make sure you're covering that too.
Absolutely.
Great. So Nancy, I'm going to start with you on this topic. And I think everybody does this differently. Everybody has different tools, different ideas, different risk tolerances. But in your mind, what's best practice for customer risk rating at account opening? So kind of when you're letting folks in or before you're letting them in, what's best practice there for customer risk rating?
Absolutely. So first, make sure you have your methodology in place of, again, we talked about this already, but what you're going to rate. We know CIP is not rated. It's your verification tool. But for nature and purpose of your client, you want to have a really clear idea of what are those particular attributes to include, and what factors. This gets back a little bit to the question earlier about, sometimes even if you look at some of the factors that you look at best when it comes to account opening, like, a new client, where's the new client located, their source of wealth, their source of income, the products and services they want to purchase or they want to use at your firm, whether they're going to be conducting international transactions. Again, some of this could be could be really helpful when it comes to building that profile, and then not only building the profile, but then having that baseline for monitoring going forward to determine what changes. I'm going to take a moment and talk about expected activity, because I know there's a lot of people
One of my favorite topics.
Yeah, it's a very clear topic, and regulators like to see and want to see expected activity, even though once a client starts transacting, that expected activity, the longer you have that relationship, the less meaningful that data really becomes. But now you have a new baseline, so it really needs to be free flowing and thinking through. But really consider, if your institution's not collecting it, I would suggest and consider you think about doing that. The value and the volume, and on top of that, really understanding not only who's going to be your high cash intensive businesses, but also who is going to be using, fintech partnerships, Swift messages with other fintechs, RMA keys. I mean, there's some complexities coming out in the newer payment methods that we really have to consider how we're going to allow that, and whether you put in place instead client having, before they do real-time payments, day one, new client, think about whether that's a process for your firm that you want to perhaps delay an offer later on, or delay it to certain client types until you really understand how that's going to affect your bank's risk profile.
So before I go to you, Hunter, I see somebody has their hand up. We can't go to voice for you. So if you wouldn't mind, if you have a question, throw it in the Q&A and we can come to it. I haven't had any questions yet. So if somebody could throw in just a hi in there so we know that it's working, that'd be amazing. But Hunter, I'll go to you. So Nancy gave a great explanation. What are your thoughts on best practice for customer risk rating at account opening?
So if your system can do it, I'm strongly in favor of customer risk rating at account opening. The sooner you can get your hands around who are and are not your high risk customers, so that you can perform your reviews early on, so you're not surprised. Depending on your system, you may need to manually run customer risk rating on a set interval, and you might find some things during that review that you might have appreciated knowing earlier. It can help put things on your EDD schedule, make sure you have appropriate staffing. I think that, to Nancy's point about expected activity is not only good for EDD purposes and developing customer risk profiles, but it helps protect you and your customers, depending on the nature that they are. For example, in nonprofits, charities, if you're a smaller community bank, you may have some nonprofit charities that have an international exposure for transactions, and you can help educate them on the risks affiliated with that as part of your community banking program. Not only are you protecting your institution, but you're making sure that your customers get a value out of it as well. And I do agree that expected activity is probably most useful up front, and that as you go through the life cycle of your customer relationships, it's definitely going to change, especially on the consumer side, as people move, change careers, go through different phases of life. It can be something that is very key in the short term, but long term, you probably are going to be comparing more to their past 6 months if you're doing an annual review than you are what they said 3 years ago when they opened their account.
And Hunter, to add on to that, I think that when you look at it, comes down to consistency, right? Consistency 100%. And explainability. So your risk ratings have to be applied consistently across your customer base. And I do think that is initially and ongoing. And so you may say, oh, well, my firm does after the client's with us 6 months, then we kick off our EDD and we do. Okay, well, but that still doesn't preclude the fact that you have to do some level of EDD initially at onboarding so that you understand whether this is a risk. Because once that customer becomes a client of your bank, let's say it's a lending product, it becomes a lot more difficult to perhaps have a client decision related to that, to the activity you're seeing at that point in time.
Totally agree. It is a lot easier to keep someone out than it is to kick them out.
Right.
Yes, amen to that. So one other thing I want to mention is the explainability part. I've seen, again, other firms, they use all sorts of risk ratings, whatever you want to use, a simple one, high, medium, low, high, medium, standard, or something more complex. That's up to your firms to make that decision of what you want to do, but really make sure you have an ability to distinctly explain what each of those risk ratings mean and what is your internal controls applied to them. If you're using the same type of internal controls in terms of monitoring reviews, negative news, etc., type of reviews for a kind of a standard client to a high-risk client, then you're going to receive a lot of scrutiny around that process because, again, your controls are not commensurate with the risk you're taking on. So make sure you have that documented it well.
Awesome. And I'll throw this out to you, Hunter, to start. This is another kind of little curveball question, but I'm sure you're comfortable with it. Different financial institutions have different levels of risk, right? In simplest terms, some will have low, moderate, and high. Some will have a high and regular. Some will have high, nuclear high, medium high, medium low. Like 17 different categories. What are your thoughts on kind of the your best practice in layers of risk?
I think, the key point that it keeps coming back to is, as Nancy keeps saying, and I totally agree with, is robust documentation is key with whatever you go with. I do think that, you don't want to have too many different layers of potential blocks for you to put your customers in as far as customer risk rating. You want to make sure that you're able to not only keep your customers appropriately risk rated, but setting yourself up so that you can keep up with the volume of who your high risk customers are. If you choose, for example, to have very high and high, or high and higher, how are you going to review those differently? Are you going to do them all on an annual basis? Are you going to review the nuclear high every 6 months? And to your point earlier, as you become more familiar with the customer's transactions, risk basis, is it really worthwhile to have those variable levels of risk as you're evaluating the relationship? If somebody's continuously in the nuclear high zone, is this something that we need to consider exiting as either a unique customer or as an industry type? Are we doing what we need to do for just evaluating our prohibited and restricted customer lists? I think that the more explainable, the more repeatable, the better. And if you're a bigger institution, you can probably handle a more bifurcated customer risk rating. But for a medium to smaller bank, you probably need to be a little bit more holistic and not bifurcate out as much.
Great. And I will kind of highlight something that you said that I think is really important, and it's kind of a risk-based decision that every financial institution needs to make. No matter how many layers you have, in my mind, there has to be something different going on at each layer, right? So if I have nuclear high and high moderate, what am I doing with those differently? Maybe it's the cadence, right? You said maybe the nuclear highs are every 90 days or 6 months, and maybe the nuclears are 90 days, the highs are 6 months, and I don't know, high moderates are every 9 months. I can't do math well. So it's doing something differently for those and defending it, having it documented, all those things. I think if you can hand the third party that's reviewing your process something that makes sense, you're ahead of the game, and just kind of stick to it. Nancy, a question came in with your name in it, so I'm going to throw it at you. In regards to expected activity, what's the expectation in updating it over time? Like Nancy said, the longer that you have the client, it becomes less useful. So what's the standard? What's the expectation in updating expected or anticipated activity?
Mm-hmm. Yeah. So again, expected activity is a baseline to start with. And with your periodic reviews, and I think we're going to talk about periodic reviews here, I would consider looking at the actual activity that has occurred and starting to leverage that actual activity in periodic reviews, as well as in your customer risk rating decisions. Whether that's, so you have the static information, you're not replacing it, but it now becomes complementary data around the actual activity and how you're using that actual activity in your compliance monitoring functions and your client risk rating reviews, your periodic assessments, whether to file a SAR or not to file a SAR. All of that now becomes more important. Again, you don't lose your baseline, but but as you move on, of course, we're starting to see activity that is differentiating. And initially, especially with customers that new high-risk clients or new clients in general, that maybe those quote-unquote hidden highs, I would really suggest you look at that differentiation when it comes in, where you're seeing expected versus actual, because you haven't established longevity with this client yet, and that could be really telling.
Great. So important at account opening, somebody says, I'm going to do a lot of, I don't know, high-risk jurisdiction transactions. That's going to make them higher risk. And then when you're doing your first CDD, first review, maybe it's the first time you're looking at it is because they alerted in your transaction monitoring system. Take that information, compare it to what they're actually doing. If it makes sense, you're probably fine. You roll from there with actual activity, and then you probably don't need to update it. There's another question here that I think we could answer, or this is just a statement that I agree with. Expected activity is flawed, as a lot of new customers don't know what to expect if it's a new business and may over or underestimate the transaction type totals or actuals. It's very common and seen often. So I absolutely agree with that. If it's a new business, they're not going to know. I think the easy answer to that, though, if somebody is coming from another institution to yours, ask for their statements, right? Then you have their actual activity at their former institution. So it's not even expected or anticipated. It's actual that they did at the last one. And one thing I'll throw in, when you're taking on a high-risk customer, my first question, and I'm a AML professional, so I'm biased, and I am always looking for risk. My first question, especially when a relationship manager would come to me and say, hey, Chuck, I've got this great business. They're leaving their financial institution. They want to come to us. We're going to make a lot of money. My first question was always, why are we so lucky? Why does this business that is supposedly great and making lots of money and going to be an asset to us, why are they leaving their financial institution? It's hard to move banks. You have to change things, get new checks, change all your ACH transactions, all your bill pay, all that stuff. It's not fun to do. So my biased perception was always they're being asked to leave, right? And so why are we so lucky we're getting this customer? Especially at some of the institutions I worked at, we had higher fees. So it's not like they were coming to us because it's going to be cheaper. They were coming to us for some reason. So my biased thought to you is, when you're dealing with new higher risk customers, ask that question sometimes. Why are we so lucky? Another question, and I'll throw this to you, Hunter, because I picked on Nancy. Ongoing due diligence profiles. How do most banks do this? For some reason, my examiner this year thought we should constantly get updated profile forms. I explained thoroughly that our reviews become the new baseline if we deem activity to be normal and not suspicious for that type of customer. So what's the expectation, at least in your mind, about kind of ongoing due diligence and updating expected activity and forms and such?
So I think that you have to have a clearly defined procedure of triggering events to say, when, based upon my review, when do I need to go get additional information, whether it be through an RFI. Not super familiar with what the questionnaire is asking about with forms. I'm going to assume this is an account opening form. If there's things that are identified during the course of review that may have not been originally identified during the onboarding, you will want to go get that due diligence at that time. But in the sense where you have an annual review, you're generally going to be looking at what is the behavior of, and the overarching question always been, should we keep the relationship? Is the relationship high risk? To make sure that you're reviewing them, their transactions, their products, their locations. Is it appropriately risk rated? Are we monitoring it right? Is it in line with the risk appetite of the bank? Obtaining new customer forms every time you do one does seem onerous. So it may be worthwhile to have a conversation with your regulators. I know that in my experience, regulators are open to having dialogue. And if you don't have that relationship with your regulator, I would suggest to start it. They are here it's a partnership. And so I want to make sure that folks do feel comfortable to say, we can have a conversation with our regulators to say, help me understand what this feedback is so that I can make sure that I'm giving you what you need.
Great. Nancy, I'm going to throw this one to you. How often should high-risk customers' in-depth reviews be done? Annually, 6 months, something else? What are your thoughts there?
Okay, it's going to depend on your organization, right? But rule of thumb, I've usually seen them done, high-risk clients, either every 6 months or every 12 months. And but what's more important necessarily isn't the cadence, is that you have the right controls to, if something were to change within that client relationship during that periodic review time, that you have the ability to accelerate an evaluation of that high-risk client to understand what changed. Again, the premise here is to know the nature and purpose of your client activity that's occurring at your bank. And the way to do that, of course, is to have the right controls in place to detect those types of activity and to evaluate them and determine whether there requires to be a change, whether you require a client exit, restriction, a client discussion and outreach to talk through, perhaps this isn't perhaps this is not the right bank for you, or understanding what they're doing, what's changed. That's the most important thing, I think.
Great. And I think you both touched on this. If you didn't say it out loud, there's kind of customer risk rating, there's a cadence to review, but then there's trigger events, right? So there are things that happen. Maybe a subpoena comes in, or there's an interesting alert in your transaction monitoring, or if you have ongoing adverse media screening, there might be something that pops on a customer. There's trigger events that are going to change the risk rating of that customer, maybe change them up or down. And so that needs to be a part of the process. You need to have a means to identify things that are going to change the risk to your customer. And then potentially you would go and update that customer form, maybe update the beneficial ownership form. Maybe there's a reason to ask for updated anticipated activity. I think that's pretty rare because, as we've talked about, once you get actual activity, it's reasonable to rely on that. But trigger events, I think, are pretty important. A question, I'm going to start with you, Hunter, on this one. Who approves opening an account or retaining an account for a high-risk customer? Who should have the responsibility for doing that in an institution?
Yeah, so as I said earlier, not all high-risk customers are created equal. If you have a prohibited customer, everyone should be on board with not onboarding that account. But if you have a restricted customer, those need to be, in my professional opinion, need to be reviewed by the second line to make sure that the bank is comfortable with what you're obtaining, what the expected activity would be. Make sure that they may have their own AML program in place, their own processes and procedures depending on their customer type. If you have a higher risk customer that's just higher risk because of customer risk rating, I think that it comes down to the partnership between first and second line as to what is the risk appetite of your firm. And so it kind of depends on the nature of the higher risk customer. If it's restricted, got to come to the second line. If it's just generically higher risk, there should be a set risk appetite for the bank. And as a reminder, the first line does own the risk of onboarding clients. And so we want to make sure that they are educated just as well as we are.
Nancy, thoughts there? Who should approve?
Absolutely. So, my biased opinion here is that your AML officer can, or the delegate can issue a kind of a non-objection or approval of the relationship. If they don't approve the relationship, and let's say again the revenue generating business lines want to push to onboard that client, it really then becomes a more of a discussion around whether the C-suite executives and the board of directors are willing to take on that type of risk for that client. So it becomes a situation of not only who can approve the relationship, but why it has to be approved at that level, and what are the specific risk factors within that relationship that the bank's willing to take on. I think once you start to outline that and you're very clear about the facts that, say, an EDD review have identified, and those are articulated with a very clear risk management lens, usually you find, a pretty reasonable approach is, let's just not go there and bank this particular client.
Great.
All right.
We've had two questions come in on PEPs. And so, Hunter, I'm going to start this with you. The first question is just, how about PEPs is the question. Another one is kind of wading into how PEPs are not created equal. You should have maybe a spectrum for risk rating PEPs. What are your thoughts there, Hunter? And a nuance to that, does your institution treat foreign and domestic PEPs the same way?
So I'm glad you said that, because that's a real personal bugaboo for me. I grew up outside of Washington, D.C. PEP is not a regulatory defined word in the United States. Senior foreign political figure is the regulatory requirement. Yeah. And just as a reminder to everyone, the more you do above and beyond regulations, you do invite yourself to more scrutiny. So risk-based food for thought there. I do not think all PEPs are created equal, whether it be foreign, domestic, or levels. For example, a mayor, like the question asked, is very different than a member of parliament in the UK. I think that you want to make sure that you're having a risk-based decision as to what level of PEPs you're tagging. whether that be we're only going to go to the regulation and we're going to look at domestic PEPs, but they may not be deemed to be higher risk because it's not a regulatory requirement. A senior foreign political figure is a regulatory requirement that has, certain regulatory obligations to do ongoing monitoring. So that's a long-winded way to say, again, risk-based decisions to make sure you identify what type of PEP they are. Are you doing PEP screening? Was it self-identified? Are they a former PEP? Are they a current PEP? Are they a family member? If so, how closely tied are they? I think there's a lot of values that go into risk rating a PEP. And those are just a few, because I don't think there's a right or wrong way to do it, as long as you can, as you said earlier, Chuck, stand behind your decisions that you've documented when speaking to a regular about how you handle your PEPs.
Nancy, thoughts?
Well, I think, immediately when we were asking about is the question about, once a high-risk client, are you always a high-risk client? And many of us have grown up in this industry with the comments of once a PEP, always a PEP. I think, Hunter, it just rolls off your tongue a little easier than senior foreign political figures do. I've been at firms where we clearly delineate the domestic versus foreign senior political figure. But really what's important is to have that discussion with your firm about how long out of office or what degree of separation from those relationships is the PEP that you're banking.
Sure.
And also make sure you do really good negative news so that you understand, is this, I'm sure everybody's seen the YouTube video about quite frankly, elected officials and the number of financial crimes we've seen in the elected officials. It far outweighs NFL players and National Baseball League players events. I thought, oh yeah, that's interesting. But again, it goes back to make sure you do your negative news, make sure you have the right tolerance in place, make sure you can explain it. And when you do make that decision to perhaps downgrade a domestic political figure, that you're very clear and consistent with your approach.
Yes.
The minute you're not consistent, that's going to create additional risk for your bank, reputation, compliance, you name it.
Great. Thank you both on that. We have somebody weighing in, once a PEP, always a PEP. I disagree with you, and that's my personal opinion. I think it's fluid. I think there's a spectrum. I think, I don't know, if you have a former member of Canadian Parliament that's living in Florida and the only thing going through their account is annuities, it's not a high-risk customer to me. I'll give you a fun example, at least in my mind. Jimmy Carter, right? I think he's 95 or something like that. Likely doesn't have anything interesting going on through his account. The other end might be Donald Trump, right? Probably some interesting stuff going on. I think those two examples would be the opposite end of a domestic PEP. And the risk rating of those two, I think, is wildly different. I don't think Jimmy Carter needs to be a high-risk customer that you'd be reviewing on every 6 months or every year. I think you could rely on your transaction monitoring system to give you triggers and look at his account. That's my personal bias. And if you want to say once a PEP, always a PEP, I think that's fine. We're going to jump ahead because we've kind of talked about customer risk rating and onboarding, and we touched on kind of ongoing customer risk rating. I'm going to start with you, Hunter, on this, and I think this will be helpful for everybody that's listening. What do we include in a periodic review of a high-risk customer? What's best practice to throw into that process?
Sure, yeah. So you want to make sure, in my personal opinion, you're verifying your CIP information. You're verifying beneficial ownership information if it's relevant to the EDD review. Look at what has been going on since the last time you performed your periodic review. Has there been any SARs? Are they a CTR customer? Are there any alerts that came in waves? Adverse media is key. I think Nancy said that and made really good points about that. Open source or vendor provided, either way is good. Just make sure, to Nancy's earlier point with the last question, consistency is key. Make sure that as part of your documented process, you have a consistent, replicatable procedure that you can provide to your regulator and or your internal auditors, look at the transactional report. I know that we talked about expected activity. Is it a newer periodic review? Is that expected activity reliable from the account opening, or is it something that we need to look at their past behavior because now they've been a client for a decade? Counterparty research, ensure proper documentation. I'm just going down my list, making sure that any documents, because at the end of the day, what you're trying to do here is, are they still a high-risk customer? Is this somebody that we have appropriate monitoring on? And has anything changed? Is this a customer that still fits the risk appetite of the bank? And that may change year to year. It may say, given the things that have happened, adverse media, we need to speak about this with the BSA officer in the front line. So the overarching goal there is, as part of your review, it's very holistic, robust documentation with the end goal. Is this a high-risk customer? Is this a customer that fits the risk appetite of the bank?
Nancy, how about you? What goes into that?
Absolutely. I totally agree with everything that Hunter has said. And I would just add models. Let's talk a moment about models. Whether you use an Excel spreadsheet and there's computations, go back and look at the model guidance regulations, because you are likely using a model for your customer risk rating, and it needs to be evaluated every 12 to 18 months to make sure that nothing has changed. And if you think about this, isn't just a regulatory application, but our client profiles change. Something that we thought was so important may no longer be a trend or even as important. Think about NFTs. I mean, we're not really hearing anything about NFTs as much as we used to. That fizzled, thank goodness. But now also think about your customer risk ratings. They also comprise a broader kind of client segmentation method for you, so that you can use that for peer analysis. You can look for outliers in your process. You can do targeted reviews of certain client types to be able to determine whether they do pose a higher risk, or you can evaluate downgrading that particular client type again. These are all really great factors, but whatever method you use, again, make sure that you have a methodology, that it's fit for purpose for the size and complexity of your bank and clientele, and that also you incorporate that information into your risk assessment results, and evaluate not only the various types of industries and clients and high risk versus other risk factors that you may be using, longevity of your clients as well, and things like that. All of that should be baked into not only your methodology, but also your assessments, that your board, your regulators, your leadership can read and understand what type of risks they're taking on.
And to the model point, I think it's a really good idea to make sure you define what type of risk rating methodology you're using as part of that model review. Is it rules-based? Is it more holistic and fluid? And if it is risk-rated, as part of that every 12 months, is my weighting right? Do I need to earlier in the conversation, am I weighting HIFCAs, or HIFCAs, but I'm on the 95 corridor and everybody's in one. Am I doing this right? And I think that that's a really important, because at the end of the day, your customer risk rating should be helpful to identify those hidden high risk customers as well, that may not be, i.e., more easily identifiable up front.
Great. Thank you both on that. I'll add a little bit there. So different banks, different financial institutions, I guess I should say, risk rate customers in different ways. Some have a model that is doing ongoing risk. Maybe every month the model switches and takes in new information and can actively and fluidly change the risk rating of that customer. The other end of that is a static system, where maybe the risk rating is set and it only can be changed when you're doing that manual review or a trigger event or something like that. So those are the two ends of the spectrum. The thing I would say that's most important, if you have a model like Nancy was talking about, tune it. I can't tell you how many times I've dealt with a client in my current practice where they've turned on their customer risk rating model at the settings that the vendor suggested, and they've never touched it. and you go in and you look at the number of high-risk customers they have, and it's wildly too high. And the reason is they've checked off some boxes. Maybe it's HIFCA HITTA, and maybe their threshold in their points model for being a high-risk customer is 60 points, and HIFCA and HITTA is set at 50. So all they have to do is be in one of those, and then maybe they're in a higher risk occupation or business, and that gets them to be high risk. And that shouldn't be the case. So tune those. And I'll say this out loud again because I'm not a practitioner, but I'm helping people do this type of thing. All of the tools, all of the models that are available have some subjectivity in them. You can add points based on certain things, and you can influence the number of high-risk customers that you have based on the risk tolerance of your financial institution. So there's not a single way to do it. It's not for the vendor to do. It's for you to do it based on your own risk tolerance, and you should be ongoing tuning of your risk model, customer risk model, if you have the capability to do it. Don't let it sit there stagnant. Do it on an ongoing basis, especially if you change, add new customer types, new jurisdictions, new products and services, change that stuff. I have to add something because we're running out of time. We'll come back to a couple more questions. But on the September 26th at 1 p.m., our next AML Voices is going to be how adverse media monitoring can enhance your KYC and EDD effectiveness. So again, September 26th at 1, you can go sign up for that at any time on our website. A couple last questions that I want to get to before we go. Does it make sense? And I'm going to answer this one, and you guys disagree with me if you want. Does it make sense to continue to have Does it make sense to continue to have moderate risk customer reviews, or just have high risk reviews and rely on the AML software to pick up on any other customer that is not high risk? In the last 2 federal examinations, examiners have not asked for moderate reviews, just high risk reviews. And so my answer to that is that it's based on your institution, your risk tolerance. I mentioned before that some institutions have high and regular, and that's all that they have. And so in my opinion, only the highs would need to be reviewed on an ongoing basis. Your transaction monitoring would catch everything else. If you have high and moderate and low, I don't necessarily think that there needs to be a cadence of review for moderate risk customers, but there should be something you're doing different. Maybe you have ongoing adverse media screening for your moderate risk customers, so they're more likely to trigger and they're more likely to be noticed. Maybe you have different rules or different thresholds for your moderate risk customers, so they're more likely to trigger than a low risk customer. I don't necessarily think that you have to have an ongoing cadence of manual review for moderate risk customers unless it's been regulatorily mandated. And I think that's how some folks get there. But a difference of opinion from either of you on that one?
I have a slightly different opinion on that.
Good. Please go.
I think that we're in the business, we're in the customer business, whether we're wearing a compliance hat or otherwise. But we have to know who our clients are. And in order to do that, we not only have to just monitor their activities through a system, but outreach and make sure we're periodically updating information that they provided us. We want to know what's changed in their life, whether there's been lifestyle changes. And the only way to do that is to have that outreach. And this is where our revenue generating businesses that are close enough to those clients are the ones that should be doing that, not necessarily relying on a back-end system to push that information out for another operations function to review.
Great. Hunter, I've got one last question that I'm going to throw at you because we're running out of time. And I think it's important. I don't even think we talked about this when we were setting up. Can you discuss what your process is if you want to end a relationship based on risk? So somebody's too high risk, what do you do?
I think it depends on how it becomes too high risk. You may, as a firm, have a set number of SARs that once you hit a certain number of SARs, it's now time to go. You may have a situation where your customer risk team is reviewing things and noticing them. I want it to be a partnership and a collaboration, not only within financial crimes, but with the front line. There are very few instances, unless somebody somehow gets through with a prohibited customer list, where we have, in my career, demanded someone needs to go just based on policy. It's been part of a conversation, whether it be an escalation committee that is established, an informal process within the institution, depending on what your institution's profile is, but it should be a collaboration between the front line and the second line, because to Nancy's points, we are all in the customer business. They may know things about the customer that we don't know. And some alerts may be more easily explained. Sales conversations are important to have updates to customer risk profiles, just like Nancy just said. So I think that collaboration is key.
Great. I think we're out of time, but Nancy, I'm going to give you the last word. Any kind of final takeaway you want to leave this group with that's listening in?
I would say 3 words: consistency, explainability, and document.
Perfect. I think that's a great way to put a pin in it. Thank you both. You've been great with your candor and expert opinions. I really, really appreciate it. To everybody that's listening, thank you for joining us, and please join us for our next webinar. Thank you so much.
Thanks
Thank
all.
you. Bye-bye.